We are just picking from where we left from our previous video. We are finalizing with investment appraisal techniques. We have already done some. We are just doing two questions or so, and then we will be able to shift our attention to capital rationing, of which we'll be able to finalize on this topic. Hoping that we'll be in a position to do tomorrow. We will be able to do cost of capital to see whether we can be in a position to finish it. In that regard, it means that we are going to be in a good position, just remaining with around 3 topics. But a bit, the 3 topics might be a bit wide. So it's up for us to keep on working hard to ensure that we achieve the objective of us of passing the exams. So as I work on this question, I also want to do another question for April, if I'm not wrong. There is a question on April 2023, which I will be able to do once again. That question is already in the videos, which I have already shared with you for the previous semester, but I'll be able to repeat it again for better understanding. Then I will be providing, or I'll be able to give you a lot of assignments which you are supposed to be doing. So let me start by acknowledging your patience. So I hope we did November 2017 question 4C. Let me see whether it was something. Okay. There is a question which I saw some of you attempted, which is a good move. The question for 2016 somewhere. But that question I saw some few elements which you were not able to get right. There is a question based on the computation of the tax gain or loss. The tax gain, when you're getting the differences between the disposal value of the old machine and the NPV, being positive, it means you're going to be adding. When you're getting it negative, it means you just subtract. I remember we discussed about that. So we should not be able to forget about it. That was on November 2016, question 4C. That question I saw, Halim, I think it should be, taking the difference between the disposal value of the old machine, which was 1250. She subtracted the NPV of old machine, which she was able to get 1200. The difference was 50 shillings, which is a tax on gain or disposal. Then that 50 you multiply by 30%, getting 15, which is a positive. It is a gain, you add. So it means when you're getting the net cost of the new machine, you'll be able to take the cost of the new machine. We let the disposal of the old machine, and then we add our tax on gain on disposal. Now, I would like someone to read for us the question, which is ahead of us, so that we can move very quickly as we engage on finalizing on this topic. I think I have given it enough. So let us just finalize it and we move to another topic. I think the 2 topics that we have already done, they are very important. It's up to you now to focus on achieving the objective of ensuring that you do your revisions as much as you can, and I'm ready, or I will be there to support you. So someone read this question to be of August 2023. Let us see what we can do or what we were unable to do during our exam time for those who attempted the sitting. Please, someone to read.
I'll read.
Okay.
Fila Limited is considering to purchase a new machine so as to improve its production process, which is currently being undertaken manually. The machine cost shillings 13,950 million. The farm will incur installation cost of 450,000. The machine will have an economic life of 6 years, but will require an overhaul at the end of the 4th year. The overhaul will cost 11,25,000. After 6 years, the machine could be disposed of for 900,000. The company estimates that it will cost 2,100,000 per year to operate the new machine. The current manual production method costs 50,000 per annum. In addition to reducing annual operating costs, the new machine will allow the company to increase production capacity by 120,000 units per annum. The company realizes a contribution margin of 45 shillings per unit. Additional information. Number 1, the company applies straight line method of depreciation. Corporate tax rate is 30%. Fila Limited requires 20% return on all investment. Required using the net NPV project evaluation method, advise Villa Limited on whether or not to purchase the new machine.
Thank you so much. You can see how the question is being set with some few concepts which we are supposed to be learning in a few to understand what do we mean by the lump sum annuities and how are they applied in a question. So those are the things that we should be doing right now. But when I look on the question, it discusses much about understanding about how can I be able to get the NPV? How can I be in a position to advise the company? And in that case, I just want to provide the solution of the question here very quickly, because I just want to finish up with the capital budgeting. So in this case, we are being told that there is the Fila Limited is considering to purchase a new machine so as to improve its production process, which is currently being undertaken manually. So what will be the cost of the machine? That is where you start with the question. So we said step number 1, we are going to be calculating our initially. And I gave out a format for this. So here we can talk about Kenya shillings in thousands of shillings. So we start by looking, what is the cost of the machine? What is the cost of the machine? I can be able to see the examiner is telling us the cost is 13,950. 13,950. And we are being told the company will be able to incur installation cost of 450. We talk about installation costs of 450 shillings. Then, as you continue that statement, we are being told the machine will have an economic life of 6 years, but will require an overhaul at the end of the 4th year, right? An overhaul at the end of the 4th year. So the overhaul costs, the overhaul will cost 1125. So let us calculate the present value. The present value of overhaul costs. And in this case, I'm going to be taking the overhaul of 1125. And this one is going to be experienced only once at the end of year 4. You multiply it with the present value interest factor. Present value interest factor. We are talking about the discount factor of ours is 20%, 4 years, right? In this case, it means the formula which we normally apply here, and I think the next topic I should be looking on the computation of the time value for money for better understanding. So in this case, it will be 1 plus 0.2, you raise to a negative 4. So how much it is? 1.2, 1.2, you raise to a negative 4. We are getting 0.4823. So times 11, 1125 times 0.4823, we are getting 542. I can talk about 543, right? There is not any cost which is going to be affecting our initial outlay as per the information provided by the examiner. So from that case, let us just get the initial outlay. How is the initial outlay? You just need to take the summation. What is the cost? 13,950 plus 450 plus 543. We are getting 14,943. Now, when you look on the computation of the second step, which you normally have for the getting our NPV, we normally calculate our annual net cash flows. But remember, this question is divided into two. We have 1 to 4 years, 5 to 6 years. And in this case, we have to be looking on what is the cash flow generated during that period. When you look on that question here, we are saying that we need to do some few workings here. The first one will be, when I look on the last paragraph, we are being told that the new machine will allow the company to increase its production capacity by 120,000 units per annum. And then we are being told the contribution margin per unit is 45 shillings. I can even do it directly. So in this case, when you look at it, so when you look on the contribution of hours, the contribution will be 120 times 45. How much it is? 120 times 45, we are getting 5,400. 5,400. Then we need to also to be looking on the what are the savings, because when we save, it means the savings is part of our income. Ukienda kwa duka, you estimated to purchase a shirt as 1,000. Now we know 800. The 200 becomes your savings. So in this case, when you look on that last paragraph, we have been told the company has made that it will cost 2,100 per year to operate the new machine. So the current manual production method costs 5,250, right? So what is the cost savings here? Becomes our income. The cost savings we are going to be taking 5,250 minus 2,100. 5,250 minus 2,100. We are getting that 150. That 150. From there, you have to be asking yourself, right? Is there anything that needs to be computed here? And we say no. In this case, we are getting around 8,550. So once you get 8,550, it is very important for me to calculate the depreciation, because this is just an annuity. So concept which we are going to be working on it. So in this case, let me get my depreciation first. So what is my depreciation? I can see very well we are being told the new machine, right? We are being told there that what will be the cost of the new machine before the present value of the overall cost will be the 2. This should be translating to 14,000, right? It should be 14,400, if I'm not wrong. So in this case here, we are saying, can I be able to take the cost of the new machine? So it will be very simple. I will be able to say the cost of the machine will be equal to 14,400. You minus, right? We subtract what? We have been told in the question after 6 years, the machine will be disposed at 900, right? Then we divide it by 6 years, correct? Allow me just to calculate this thing directly. Where we'll be able, so let me just follow this one. So 14,400 minus 900, we are getting how much? 14,400 minus 900, we divide by 6, We are getting a depreciation of 2250. Then from there, remember, we have been told that there is an information provided there regarding the overall costs. You need to be asking yourself, what will be the overall cost per? Because the overall cost is going to be affected. This overall cost is going to be incurred for only 4 years. But remember, based on the computation of years, you are running your depreciation for the whole year. What about the overall costs for the remaining years, right? What will be the overall for the remaining years? What you need just to do here, the overall costs. I'm going to be taking 1125 divided by 2. I get 562.5. I'll show you why. Then you get the total plus 2250, getting 2812.5. Now, this will be the depreciation between year 1 to year 4. This will be the depreciation between year 5 and year 6. Now, from there, we are going now to be calculating our annual net cash flows. So in this case, allow me just to regroup because we are being told here that from year 1 to year 4, right? Year 1 to year 4, we're going to be having a different concepts to year 5 to year 6. So let us just separate them here. We say year 1 to year 4. Then we have year 5 to year 6. Get shillings in thousands of shillings. Correct. So what are we going to be starting our question with here? Our question will be started with what we are having there. It is normally called the earnings before depreciation and taxes. So the earnings before depreciation and taxes between year 1 to year 4, we are going to be taking 8550, which we computed up there, this one. Then between year 5 and year 6, it is going to be the same, 8550. Then I can say, can we be able to less our taxes? Right, at the rate of 30%. So what will be the rate of 30%, how much it is? So in this case, we just say 850 or 8550 times 0.3, getting 2565. Then the other side will be 0.3 times the same 2565. Then allow me to add depreciation tax shields, right? Which we are going to be taking our depreciation. We multiply by tax rates. So our depreciation here, we say 2250 times 0.3, right? 2250 times 0.3, getting 675. On the other side will be 2812.5 times 0.3. We are getting 843.75, right? What is your annual net cash flows? What is your annual net cash flows? So in this case, I take 8550 minus 2565 plus 675. We are getting 1660, 6660. On the other hand, we are saying 8550 minus the subtraction minus 2565. We add 843.75. We are getting 6828.75. Now, the other question is, do we have the terminal cash flow? Do we have the terminal cash flow? The terminal cash flow that we have here, we know very well our terminal cash flow will be for the new machine, the scrap value of the new machine, which is 900 shillings. So we can just do with it. So in this case, we just say, can you take our years, right? Someone can say, we can use 1 to 4 years. We have our cash flow. Cash flows. In this case, we are discussing a cash flow of how much? We have a cash flow of 6660. Then we have the discount factor. at the rate of 20% to determine our present values. Correct. Then we have year 5 to year 6, 5 to 6 years. Then we have 6 years, which we are going, the 5 to 6 years, we are getting 6828.75. And here we are going to also to be getting a terminal cash flow of 900 shillings. Now, after this computation now, the most important thing which I will be able to teach you is about what is this and how am I supposed to be computing it in an exam? What does it mean? So when you are discussing about 1 to 4, this it means it is an annuity concept, which allows us to get the similar cash flows from year 1 to year 4. And this is what it means to be, this is an annuity. Correct? Then this is our lump sum. Lump sum, it means this cash flow is going to be recognized only one in the entire life of the project. This is an annuity. So what is the formula for annuity? I say to calculate our annuity, which we normally, and I will be able to recognize these when we are doing the time value for money. We normally take the present value and interest factor annuity, right? For example, we might be discussing our R%, which is 20%, N years. Sometimes now we are talking about 4 years, right? You ask yourself, what is the formula which I can be able to use here if I don't have the table? I say it is 1 plus R negative N divided by R. So in our case, I take 1 minus 1 plus 0.2, we raise to power negative 4, divided by 0.2. So I start with the brackets. I just follow the board mass. It will be 1.2, we raise to power negative 4, right? 1 minus your answer, then you divide it by 0.2, getting around 2.5887, correct? Then what about year 5 and year 6? So when you are looking on this, because you just need to get the discount factors between year 5 and year 6, it is very simple when you do it like this. We are going to be taking the present value interest factor annuity, 20%, 6 years, minus the discount factor that we need is for year 5 and year 6. So what am I supposed to be subtracting here? I say I'm going to be subtracting the present value interest factor annuity, 20% 4 years. Because chenye tunataka sisi ni year 5 to year 6. Year 5 to year 6. So in this case, it is very simple. Let me apply my formula here. 1.20, I raise for negative 6. 1 minus answer, then we divide it by 0.2. We are getting here 3.3255 minus the present value interest factor annuity, 20% 4 years, is what we have gotten up there, which is 2.5887. So how much am I getting there? So the difference is 3.3255 minus 2.5887, getting 0.7368. 0.7368. Now, after you get that, after you get all that, what we are supposed now to be doing is to determine for lump sum. And you remember we have already worked for lump sum, which we said it is 1 plus R. We raised for negative N. It will be simple by taking 1 plus 0.2. You raise it to power negative N, which is 6. We are getting 0.33449. Then you take your cash flows, you multiply by what? You take your cash flows, you multiply by discount factors. The first one will be 660. You multiply it with 2.5887, getting 17 to 40. 17, let me talk about 241. Then the other one will be 6828. 6828.75 times 0.7368. We are getting 5031. 5031. Then the other one will be 900 times 0.3349. We are getting 301. So what is the present value of cash inflow? What is our present value of the cash inflow? The present value of the cash inflow will be how much? 17,241 plus 5031 plus 301. We are getting 22,573. Then we less our initial outlay. Our initial outlay, we were able to get how much? How much was our initial outlay? It was around 19 or 14. 14,943. 14,943. What will be our NPV here at the end of the day? So minus 14,943, we are getting 7630. 7630. So in this case, when you look on the question, the examiner was asking you to be in a position to advise. Using the net present value project evaluation method, advise Fila Limited on whether or not to purchase the machine. And what we are supposed to be giving here as advice will be the project can be undertaken, or the machine can be purchased because NPV is positive. Because NPV is positive. Because NPV is positive. Because NPV is positive. So we can be able to undertake the project. That is what is all about the question. Any question? Any question? Now, let me do another question. I think I'm remaining with two before I look on the capital rationing. So let us look on a question here for April 2023 so that I can give you assignments now. April 2023 here, we have a question. Who's reading for us now? I think Dan should be reading for us. Even the question is question 1B. Someone reads? Oh, I wrote August 2023. It should be August 2023, sorry. For the question. Let us continue. Done? Go on.
No. Let me read that.
Yes.
SIPO Limited is evaluating an investment project which requires the importation of a new machine at the cost of 3.7 million. The machine has useful life of 6 years and a salvage value of 1 million. Additional information. The following additional costs will be incurred in relation to the machine. Modification cost at 1 million, import duty at 900,000, installation cost 375,000, freight charges 225,000. Two, the machine is expected to increase the company's annual cash flow before tax as shown below. Increase in cash flow, year one, 1,760, year two, 1,360, year three, 1,050, year four, 900, 95,840, AR6, 750. The machine is to be fully depreciated over its useful life using the straight line method. The corporate tax rate is 30%, while the cost of capital is 10%. The maximum accepted payback period for the company for all capital projects is 4 years. Required. The total initial cost, 2, in annual net cash flow, 3, payback period of the machine, 4, net present value of the machine.
Thank you so much. I can see this question is going to test us on the formula of ours, or the format which we use in the computation of the NPV. The question is asking us good questions which we have to be answering. Good problems which we think they will be assisting us to determine what is asked there. So what you need to do is first understanding. What is the first understanding of the question, and then from there we are in a good position to understand what the question needs. So in this case, we are just going to be following our procedure for the computation of the NPV, as we have already always doing. So so in this case, it is very simple. We're just going to be starting with the number A, right? What is our number A? We are going to be starting with our initial. What is our initial today? And we say, this is what we say it is IO. Kenya shillings there, right? You look on the cost of the new machine. What is the cost of the new machine? From the question is provided there, the cost of the new machine should be translating to, this camera is letting me down. The cost of the new machine here, we are being told that the importation of the new machine will be having a cost of 3.7 million. So let us reduce our shillings to thousands. Then we add incidental costs. And you can see NPV is always in every semester. So our incidental cost, we have what? As per the question, additional information number 1, we are being told we have modification costs. Our modification costs amounts to 1,000. The second one will be import duty. Our import duty, we have 900. Then the next thing we have is installation costs. Our installation cost, we have what? Our installation cost is 375. Then the last one, we are being told we have freight charges. How much is our freight charges? We are being told is 225. What is the total here? The total will be 1,000 plus 900 plus 375 plus 225, getting 2,500. Then we add there. What I'm going to be getting here is the total cost of the new machine. What is the total cost of the new machine? It will be 2,500 plus that 700, getting 6,200. Always don't forget, if you are not disposing a machine here, thank you. If we are not disposing a machine, the other part is irrelevant. Then if we add investment in working capital, tungeweka hapo. So the total cost or our initial outlay will be equal to 6,200. Part 2 of the question of B, we are going to be calculating our annual net cash flows. And as per the requirement of the question given there, And additional information number 2, we are being told the machine is expected to increase the company's annual cash flows before tax, as shown below. So in this case, I can see the increase in the cash flow. They are given in lump sum. There is no any cash flow which looks like the other. So we have 1, 2, 3, 4, 5, and I think we have here 6 there. Right? They are looking like that. Then we start with the increase in cash flows. Increase in the cash flows, we have how much? So in this case, when you look on the increase in the cash flow, year 1 we have 1760. Year 2 we have 1360. Here we have 1050, right? The other one we have 900, 840. The other one we have year 6, 750. I always like to use the shortest formula as possible. So in this case, I just want to deduct my taxes here. Less tax at the rate of 30%, unless otherwise stated. So 0.3 times 1760. We are getting 528. 1360 times 0.3. We have 408. Then the other one with 1050 times 0.3. We are getting 315. 900 is around 270. There we have 840 times 0.3. We are getting 252. Then we have 750 times 0.3. We are getting 225. Then what we are supposed to be adding here, we add depreciation tax shield. We say another depreciation tax shield. Can you be able to take the cost of the machine? The total cost of the new machine is 6,200 minus what is the scrap value of this machine? We have been told very well that the scrap value of this machine will be 1 million. 1 million. In our case here is 1,000. You divide it by the useful life of the project, which is 6 years. Then you are going to be getting the depreciation per year, the depreciation, correct, times 30%. Times 30%. So 5,200 divided by 6 times 0.3, we are getting 260. So we add 260 here throughout. 260, 260, 260 here, 260, and here we have 260. So what is our annual net cash flow? You can see this concept is very short. This concept is very short. What is the annual net cash flows? So in this case, we have 1760 minus 528 plus 260. We are getting 1492 here. The other one will be 1360 minus 408 plus 260. We are getting 1212. Third one will be 1050 minus 315 plus 260, getting 995. The other one is 900. I think this should be equal to 890. 900 minus 270 plus 260, getting 890. The other one will be 840 minus 252 plus 260, getting 848. Then the last one will be 750 minus 225 plus 260. You are getting 785. 785. Let us go to number 3, where we normally calculate the terminal cash flow, right? Kenya shillings here, we reduce to thousands. We normally take the scrap value of new machine. The scrap value of the new machine, we are talking about 1,000, right? If we could deduct the scrap value of all machine, which we don't have in our case here. Then if we had investments in working capital, Atuna. So our terminal cash flow is 1,000. Let us look on the years. So here we have the number of years. We have our cash flows. We look on the discount factor, which is the rates we are using. The rate which we are using for this, we are being told, we are using which rates? Someone? We are using here, we are being told note number 4. The corporate rate of tax is 30%, while the cost of capital is 10%. So you multiply by 10% to get our present value. Correct. So we have how many years? 6. So 1, 2, 3, 4, 5, 6, 6. Because of the terminal cash flow. So the first cash flow is 1492. The second one is 1212. The third one is 995. All right. The fourth one is 890. 848. Then the last one is 785. Then our
Hello, sir.
Hello.
Mwalimu.
Yes.
Mwalimu. We are not seeing what you are writing. The screen just stopped a while ago.
Sorry. Sorry for that. Let me see. What about now?
Yeah. So, okay. So kindly start from where we were at calculating the annual cash flows, the end of the tail end of it, because we did not start with the terminal cash flows. It stopped right there.
1 minute. 1 minute now. One minute. The challenge here. Where now? I think it is okay now. So you are talking about this one? I think my network is the one that has a problem. We were looking on this, the calculation of the annual net cash flows. We have the increase in the cash flows as provided by the examiner. So we were discussing about the annual net cash flows, and sorry for that. We are picking the increase in the cash flows as provided by the examiner. Then we less our taxes, the rate of 30% times the cash flows. Then we add depreciation tax shields, which we said, can you be able to take the cost of the machine, which is the total cost of the new machine? Normally take this one, right? Not the total here. Now, in that case, you subtract the scrap value of the new machine. Then you divide by the number of years. Then later on, you multiply by tax rate, which is 30%, to get the depreciation tax shields. All of that you add, then you get your annual net cash flows. From there, we are going to the terminal cash flows. We take the scrap value of the new machine, which is 1,000. We let the scrap value of the old machine, which we don't have, And then if we could also have the investment in the working capital, we could have added there. The what we are getting down there, it is the terminal cash flow of 1,000. Thereafter, we want to discount to get the present value of the cash inflows. We less our initial outlay, we know whether the NPV is positive or not. So in this case, it means, right? In this case, it means here we are going to be using a formula, which is normally tend to be 1 plus r we raise for negative n. 1 plus r we raise for negative n. So in this case, it means we're just going to be taking 1 and then we run with the number of years. So the first one will be 1.1. We raise for negative 1. We are getting 0.9091. The second one will be the second here. So it will be 1.1, I raised for negative 2, getting 0.8264. We go to year 3. Year 3, we are going to be getting 0.7513. We have year 4. 0.6830. Year 5. Getting 0.6209. Then we have the last one. 0.5645. Then you repeat it here. So you multiply your cash flows with the discount factors. I'm sorry for that challenge you're experiencing now. So it will be 1492 times 0.9091. We are getting 1356. Now, the second one will be 1212 times 0.8264. We are getting 1002. The other one will be 995 times 0.7513, getting 748. The other one will be 890 times 0.6830. We are getting 608. 848 times 0.6209, getting 527. The other one will be 785 times 0.5645, getting 443. And the last one will be 1,000. This translates to 565. What is the present value cash inflow? Right? What is the summation there? So the first one, it will be 1356 plus 1002 plus 748 plus 608 plus 527 plus 443 plus 565. We are getting 5249. Let's finish shortly, which is 6200. What is our NPV? What is our NPV there? So our NPV should be equal to the difference between the 5249 minus 6200, getting 951. Getting 951, which is negative. So in this case, how are you going to be advising the investor? Right? The importation is not recommended. The importation is not recommended. The importation is not recommended since NPV is negative. Since NPV is negative. So the question which I want us to do, I would like us to do the following questions as assignments. We have December 2022, question 3C. December 2022, question number 3C. We have August 2022. It should be question number 5A. Then we have another question in May 2016, right? There is a question there. May 2016, we have a very good question there, which you can go and do some practice, May 2016. And all the questions, I just need to see them being posted in our WhatsApp group. So allow me to finalize by looking on the capital rationing. let me just to finish up with it by looking on the capital rationing. So I hope you have your notes there. Let us open mine, that you can look on what is all capital ration, what is all about this capital rationing. Just 1 minute. One minute. What is the capital budgeting here? Let me share right now. Okay. I hope you can be able to see the notes. So we are saying the capital rationing refers to a situation of capital limitation, where the company is unable to undertake all the projects with positive NPV due to limited funds. So we are saying such limitation can either be caused by the external factors, right, which are beyond the management's control. Those are the external capital rationing, or they are normally called ad capital rationing, or internal factors, which are the internal factors which are within the management's control. They are normally called soft capital rationing, or we should be discussing about so let us start by looking on the capital causes of the ad capital rationing. The firm may be unable to raise enough funds due to existing financial obligations to a contract, restricting additional borrowing. Number two, we have lack of assets to pledge as a security for additional borrowing. The third one is the investors may be unwilling to increase their investment in the firm. Then number four, a company that is not listed may be unable to raise any additional funds through the issue of ordinary shares to the public. Now, what are some of the causes of the soft capital rationing? We are saying the management may implement some measures which will result to the company not being able to raise the required amount for undertaking all the profitable projects. So the management may avoid issue of additional debt so as not to increase the firm's gearing, or these are the financial risks. We're also saying that the issue of additional debt may be avoided so as to not increase the fixed finance cost of the in form of interest. Issue of additional, these are the things which you can be able to read and understand. But we just need to know that the soft capital rationing, they are beyond, these are the things which the management can work out and eliminate them. But the external, they are beyond the management's control. Then what do we normally do with the projects which here is where we are going to be understanding this concept you are reading about the types of capital rationing, where we were discussing about, let me show you here. What you are going to be using in this question here is the matters of divisible and indivisible projects. So in this case, the examiner will be going to be asking to do the question as per the divisible projects or indivisible projects. So in this case, you need just to be understanding what is a divisible project. And we say divisible projects are projects that can be scaled downwards, hence implemented partially. While a divisible project cannot be scaled down, hence can only be undertaken if 100% of the initial outlay is available. So how do we normally work on this? So when you are looking on this kind of a question, there is a question here there is a question here. Question number, should be question number what? Let me check. It should be May 2016, question 4D. May 2016, question number 4D. The other question which I was giving out should be, the other question should be what? The other question which it was on, sorry, it should be on May 2016, question number 1B. The assignment which I was giving out is May 2016, question 1B. But let us look at this question for 2016, May 2016, question 4D. And see how you can be able to work on a capitalization question if they tend to test it in our coming exam. So the capitalization if will be 4D3. Who is reading for us now quickly as we finalize on this? Someone read, please. Who's reading for us? Yes, yes.
Laika Limited has identified 5 investment projects with the following details. Investment, initial outlay, net present value of investment. A, initial outlay of 120 and NPV of 224. B, 160 NPV of 43.2. C, 100 NPV of 17. D, 90 NPV of 21.6. E, 110 NPV of 19.8. Additional information 1. None of the investment projects could be delayed. 2. Amount available for investment is limited to 300 million. Therefore, the company cannot undertake all the investments projects. 3. All the 5 projects are divisible. Required. Advise the management of Laika Limited on the most appropriate investment projects to undertake.
So this question is very simple. As is just understanding about what is a divisible project, what is a divisible project. And I remember there before, we said, when you're doing these questions, always look at the computation of the PI, which is going to be assisting you to rank the projects to determine which is the best and which is the worst. And remember, you're going to be investing from the best projects downwards. So in that case, let me just show you how you're supposed to be sorting this question. So when you look on this question, it is very important for us to understand how do we normally get the profitability index, which is our PI. I say to get our PI, we normally take the present value of cash inflows. We divide it by our initial fee. Correct. Now, and in this case, we just need to understand when you look on the formula which we normally use to calculate our NPV, we normally take the present value of the cash inflows, the present value of the cash inflows minus our initial fee, So in this case, it means based on the information which you have given there, and if you can be able to check it properly, we have given some projects, right? Then we have initial list provided, correct. So we have project A to E. So we have these projects A to E. The cost here, let us limit to millions of shillings. So in this case, we are going to be having 120, 160, 100. We have 90 and 110. Correct. Then, can we be able to understand that if already we are being given the initial place, as the examiner provided us with the NPVs, when you look on this question here, the examiner has given you the NPV, right? And you have the initial place. What am I going to do to get the present value of the cash inflows? So to get the present value of the cash inflow, it means I'm going to be picking my NPV plus my initial fee. The NPV plus the initial fee. So in this case, it means the first one will be 120 plus 24. We are getting 144. The other one we have 160 plus 43.2, getting 203.2. The third one will be, the third case here will be 100 minus plus 17, getting 117. D of our scenario here, we have 90 plus 21.6, getting 111.6. Then the last one, which is our E, we take 110 plus 19, we're getting 129.6. Correct. From there now, you can be able to calculate your PI. How can we be able to calculate our PI? Very simple. When you look on the PI, we can be able to say, when you look on the PI, you just need to take your calculator and then you apply your formula here. So in this case, it means the present value of the cash inflow. The first one is 144 divided by, what is the initial today? 120. Here we are getting 1.2. The third one, the second one will be 203.2 divided by 160, getting 1.27. This one is the 1.17, 111.6 divided by 90, getting 1.24. Then the last one will be 129.6 divided by 110, getting 1.18. Then you rank your projects. Which one is the best to the worst? So in this case, when you are ranking, this is what you are supposed to be doing. And the examiner there is telling you all the 5 projects are divisible. We can invest partially of the projects, but divisible, it means you cannot be able to invest. It is either you meet the full initial play or you leave the projects. So in this case, that is the one thing you need to differentiate. This is our best project, number 1. Number 2 should be this one. Number 3 should be this one. Number 4, and then this is our last projects. Now, remember the amount that we have in these projects. The optimal allocation that we are supposed to be investing on our projects is 300 million. So let us look on how can we be able to invest that 300 million. So the optimal allocation of 300 million, which is available. So this is very simple. We normally look at, we normally take your project based on your ranking. The project based on the ranking. So the best project for us is B. We have the second, which is D. So for example, let me start with the initial.
Hello, sir.
Yes.
Mwalimu. The screen again, imekata.
Mambo ya leo ni ngumu. Okay. Thank you. So in this case, we are going to be taking our project. Then we look on the amount that we have, we allocate on our project. The best project requires 160 as initially. So here we talk about 160 million. Then the second one, we have not exhausted 300 million. So we look on D. D requires 90 million. What is our third best project? Our third best project is A. And in this case, A requires 120, but because we are dealing with a divisible project, we can invest partially of the remaining money, right? As an initial, we can invest partial of project A. So in this case, it means when I look on the 2, they equate to 250. The 250, yes. It means the remaining amount now is 50 million. If we were dealing with the indivisible projects, we could already invested on the first 2, then we have a surplus of 50 million. But because we are dealing with divisible projects, we can invest partial over certain projects. Now, from there, we just want to calculate the NPV of these projects which we are dealing with. When you look on the NPV of project B, right? NPV here. The NPV of project B, because it is needed. So in this case, you look on the NPV of project B, you find the NPV of it is for 3.2. Now, what about D? The NPV for D is around 21.6. Then the biggest question will be, Mwalimu, how am I going now to be getting the NPV for A? Because the NPV provided in the question is for 120 million. But we want to get the NPV for 50 million. And you can be able to equate it. If the NPV of that amount, right? Or you can come up with a proportion. We say, let us get a proportion of 50 to the original initial play needed. So it will be 50 million divided by 120 million. You multiply by 100%. You ask yourself, what is the proportion here? Or you can equate. If 120 is equal to that, what about the other one? You're going just to be getting the same answer. So 50 divided by 120, getting 41.67%. Then you multiply it with our original initial, NPV. Our NPV for A is 24, correct? So it means we have only we have already facilitated for the initial outlay for A of around 41.67. So in this case, what is the initial outlay for that 50 million? We get it, it should be 10. It should be 10 now. So what is the total NPV? What is the total NPV? So the total NPV here should be the summation, 74.8. 74.8. That is how we normally do the questions of divisible and indivisible projects. Divisible and indivisible projects. You can try November 2017. November 2017, we have question 3B. Then the other one we have May 2017, question 1C. May 2017, question number 1C. You can be able to go through the video. Also, today is not our best video because it has a lot of problems today. But just go through it, get the knowledge. Thereafter, you will be able to understand those concepts, do your assignments, share them in our WhatsApp group. We will discuss. The WhatsApp group that we have is not only for classes, but also for discussions. It should be also for you guys discussing the areas of concerns. I have seen some groups doing the same, so why not this one? So let us do it, and we see where we shall reach. So let us stop at that point. Don't look for me today in the evening. I will not be available. That is why we have done our class in the morning. Then we can see each other tomorrow. Is that okay? Is that okay? Hello?
Yeah, it's okay.
That's okay for me.